For 80 years, the most valuable object in the global economy wasn't a metal. It wasn't oil. It wasn't a factory or a fleet of ships. It was a promise. Specifically, a promise from the United States government that if you lent them money, they would pay you back. We call them U.S. Treasury Bonds. They are the bedrock of the financial universe. They are what banks use as collateral, the safety deposit that allows the global credit machine to spin. For decades, holding a U.S. bond was considered risk-free. It was better than cash. It was the pristine asset, the adult in the room. But something changed. While the world was distracted by stock market rallies and AI bubbles, the plumbing of the financial system began to leak. The people who run the machine, the central bankers, the sovereign wealth funds, the institutions with trillions on the line, quietly started moving the furniture. They stopped trusting the promise, and they started buying the rock. We are witnessing the great collateral shift. It is the most boring-sounding event that will absolutely change your life. Because when the banks stop trusting the debt, the money in your pocket changes forever. To understand why this is happening, you have to understand a very simple, uncomfortable reality about banking. Banks don't trust each other. If Bank A lends money to Bank B overnight, which happens billions of times a day, Bank A wants insurance. They want collateral. If Bank B goes bust by morning, Bank A wants something they can sell immediately to get their money back. For the last half-century, that collateral was almost exclusively government bonds. Why? Because they were liquid. You could sell $1 billion of treasuries in a second by clicking a mouse. They were stable. They were good as gold, without the hassle of actually being heavy physical gold. But in 2022, the math broke. Inflation spiked. Interest rates followed. And when interest rates go up, the value of existing bonds goes down. It's a mechanical seesaw. The risk-free asset lost 40% to 50% of its value in long-duration terms. Imagine walking into a pawn shop with a Rolex that you think is worth $10,000, and the pawnbroker looks at it and says, "Best I can do is $5,000. That is what happened to the global banking system. The collateral shrank, and suddenly the masters of the universe realized they had a problem. Their pristine asset had a counterparty risk. It had a volatility risk. And perhaps most terrifyingly, it had a political risk. So they looked for an alternative. They looked for an asset that has no CEO, no board of directors, no quarterly earnings report, and importantly, no liability to a government that is $35 trillion in debt. Let's get technical for a moment, but I promise to keep it simple. The turning point wasn't a headline on CNBC. It was a rule change in a quiet office in Switzerland, at the Bank for International Settlements, the central bank of central banks. They call it Basel III. Most people fell asleep halfway through that sentence. But here is why it matters. Under the old rules, gold was considered a Tier 3 asset. It was viewed as risky, speculative, almost dirty. If a bank held gold, they had to hold a lot of cash against it as a safety buffer. It was expensive to own. The system was designed to discourage banks from hoarding metal and encourage them to buy government debt. But then, the rules changed. Gold was moved to Tier 1. Suddenly, in the eyes of the regulators, a bar of physical gold became the accounting equivalent of cash, risk-weighted at 0. This was the starting gun. The regulators effectively told the world, banks, you can now hold gold to protect your balance sheet and we will treat it the same as dollars. Why would they do that? Why would the architects of the fiat money system elevate their ancient rival gold to the highest tier of safety? Because they can read a balance sheet. They know that in a world of sovereign debt crises, the only thing that isn't someone else's liability is gold. This brings us to the uncomfortable math. The United States government is currently adding $1 trillion of debt every 100 days. When you buy a bond, you are buying a stream of future payments. But if the government has to print money to make those payments, the purchasing power of that money is being diluted before it even reaches your account. The bond market is no longer offering a risk-free return. It is offering return-free risk. Central banks around the world, specifically in the East, have done the math. They realize that holding US debt is a losing proposition. If they hold the debt, they get paid back in devalued currency. If they sell the debt, they crash the market. So, they are doing a collateral swap. They are letting their bonds mature, taking the cash, and immediately buying gold. Look at the data. In 2022 and 2023, Central bank gold buying hit levels we haven't seen since the 1960s, back when the dollar was still officially backed by gold. China, Poland, Singapore, India, Turkey. They aren't buying paper gold. They aren't buying ETFs. They are taking delivery. They are putting the metal on planes and flying it home. This isn't an investment strategy. This is a defensive perimeter. They are building a new collateral system that doesn't rely on the US Treasury. Here is the irony. If you turn on the financial news in New York or London, they will talk about the S&P 500. They will talk about interest rate cuts. They will talk about the soft landing. Gold is treated as a curiosity, a pet rock, a relic for doomsday preppers. But if you look at what the smart money, the sovereign-level money, is actually doing, the story is completely different. The West is selling gold to buy tech stocks. The East is selling debt to buy gold. The West views gold as a commodity that goes up and down. The East views gold as the only neutral collateral in a world that is fracturing. Think about the sanctions on Russia in 2022. The US froze Russia's dollar reserves. Over $300 billion, paralyzed with the push of a button. Regardless of your politics, if you are a central banker in Brazil or Saudi Arabia or China, you saw that and you learned a lesson. If your wealth is held in dollars, it is yours only by permission. If your wealth is in gold, sitting in your own vault, it is yours. Period. That is the shift. We are moving from a system based on trust, trusting the US not to debase the currency, trusting the US not to sanction you, to a system based on possession. So, what happens when this shift completes? If gold becomes the preferred collateral for international trade and banking reserves, the price cannot stay where it is. Currently, the price of gold is determined largely by paper contracts traded in London and New York. It's highly leveraged. For every ounce of physical gold, there are hundreds of ounces of paper gold traded. But as banks demand physical metal to use as Tier 1 capital, the paper market becomes irrelevant. You can't use a paper promise as a physical settlement. This creates a squeeze, a run on the bank, but the bank is the COMEX, and the depositor is the global banking system. If bonds continue to look shaky, if the US debt spiral accelerates, banks will demand a higher premium to hold debt. But gold yields nothing. So how does gold compete? It competes by repricing. If gold is to serve as the collateral base for a fractured global economy, it has to be valued high enough to support the liquidity needs of the world. It can't do that at $2,000 or $3,000 an ounce. To match the volume of global trade and credit, the collateral has to expand. We often think of money as a static thing. A dollar is a dollar, but money is just a hierarchy. At the bottom, you have credit, promises to pay. Above that, you have currency. Above that, you have government bonds. For 80 years, the bond was at the top of the pyramid. It was the ultimate truth. But the pyramid is inverting. The debt has grown too large for the foundation to hold. The promises are too expensive to keep. The banks are quietly swapping the paper promise for the physical reality. They are preparing for a world where the only person you can trust is yourself. The question isn't whether gold is a good investment. The question is much simpler. When the most sophisticated financial institutions in history are rushing to the exit of the bond market and stacking metal in their vaults, do they know something you don't? Thanks for watching. Make sure to follow for more insights.